hoping nobody'd stand up and leave, to be honest. So that's good. That's good you're all here. Okay, so let's start with banking. Let's talk about banks. And so I put this together this morning, Silicon Valley Bank analysis. So again, I will put this up on your, I haven't put it up yet on your canvas. I just finished it earlier today. I quickly put this together just to give you something for us to think about and as we and to look at, right? So not for distribution again. Everything that I put up here is not for distribution. It's my personal opinions. So I don't want somebody on whatever is the latest social media stuff. I don't want it flying around there. Okay. So industry structure. Some of you may or may know it, some of you may not know it. First of all, I hope there isn't much exposure to CSFB at this point in terms of our jobs. At least Johnson's exposure, I talked to Drew. I know there is some exposure, but I hope it's not too much. CSFB is in trouble. We will talk about whether it makes rightly or wrongly so. Hard to figure out sometimes with these firms because banks especially are very, very hard to analyze. Because there's so much hidden away in their balance sheets, so much hidden away in their financial statements that it's very hard to analyze banks. And when I talk about straightforward regional banks are actually easy to do. It's banks like CSFB and Goldman and JP Morgan and stuff like that that are big money center banks that are hard to analyze. Okay, industry structure, large number of banks. There's just enormous. It used to be over 8,000. Now it's around 4,000 to 5,000. Because there's been a lot of consolidation in the banking market, and there's banks buying up other banks. M&T Bank, Fountains Trust bought a bunch, M&T buys a bunch of smaller banks. So you see bank names changing, and because they get bought out. So there is consolidation, but there are a whole lot of regional banks. With a lot of variation in size, there are a lot of people overseeing it. Despite that, we have what we have witnessed over the last 3 days. The Fed is involved, the FDIC is involved, the FFIEC is involved, the OCC is involved, and then there's the Office of Supervision. Does everybody know what FDIC is? What is FDIC?
Insurance Corporation.
What is FFIEC? You know what OCC is? They're all, the OCC is the Office of Comptroller of Currency, and they are in charge, they're overseeing all of the banks. They're overseeing all of the national banks. There's a battle, this is the Examiners Council, so they're all fighting amongst themselves as to who should be overseeing these banks. So Silicon Valley, for example, the OCC lost out to the Fed. The Fed won the battle in terms of the smaller regional banks will be overseen by the Fed rather than the OCC. And so there's lots of regulatory institutions looking at these banks, but clearly you can see they didn't do a good job. That's very clear when you see what happened in the last few days. We will talk about whether the big question I'm going to ask you is: do you think Silicon Valley Bank should have been saved or not? Or another way of asking this question is: should the uninsured depositors at Silicon Valley Bank should they have been protected or not? That's the question to you that I'm going to ask, right? Do you have an answer right now? Yeah. Do you know what happened, first of all? So the bank went under, and when the bank goes under, up to $250,000, the FDIC insures all depositors, which means that up to $250,000, if you had an account, you will get paid for sure. Anything above $250,000 is uninsured money, and the question is, should that uninsured money be made whole when a bank goes under? That's the question. And anyway, let's walk through this, and I'll ask you this question again. First, let's go through. This is what a balance sheet looks like for a bank. Although some of you may have seen it, some of you may not know what it looks like. How many of you have seen this balance sheet? Okay, so let's look at the liability side of the balance sheet. The liability side of the balance sheet has deposits, very different from an industrial. It has deposits, Fed funds purchased, other borrowings, and this can be things from federal banks, debt, and so on. And then you have other liabilities. And then you have equity, which is the net worth number. And in the case of banks, you have off-balance sheet items, which and significant. It can be the same size as the liabilities. So you have significant off-balance sheet items, which are essentially letters of credit and interest rate swaps. That's what the liability side looks like. On the asset side, what is the Fed funds purchase, by the way? Okay, I need to slow down there. You need to stop and tell me, if I'm going through this and you're staring at it, we know each other well enough that I would expect you to stop and ask me. We have spent 7 weeks, and now we're going to spend another 7. So, if you're afraid of your friends, that's not a good thing. Assume you know each other too. Just ask. What are Fed funds purchase?
I think it's when banks incur a loan from the federal bank and they gain cash, but they also have to pay interest, so that goes as liabilities. That's what my broad.
So Fed funds purchase is essentially a way that the bank manages its minimum reserve requirements, which is the amount of money it has to keep with the with the Fed. Every bank has to, every day, they have to keep a certain amount to meet the minimum reserve requirements. They have to keep a certain amount of money with the Federal Reserve. So what happens is, if you are short, you have to go and buy those funds from somewhere else and pay those people. You understand? But if you have excess, you can sell it. You're with me? And that's essentially what this number is saying. If I have excess money sitting with the Fed, why do I do it? Why would I do it? Let's say Tompkins Trust has excess money sitting with the Fed. What they and Silicon Valley has a shortage. Right? You have a minimum reserve requirement, which is the amount you need to keep. Let's say I have excess amount sitting with the Fed, and Silicon Valley is collateralized, right? What can happen? I can sell my Fed funds to Silicon Valley. And what would I get in return? They would pay me an overnight rate, right? So that's the transaction that's happening. So it's happening between banks where the Fed funds can be bought or it can be sold. If I'm selling it, it means I have excess, so I'm selling it to Silicon Valley. The reason it's an asset is because I can get it back. I'm going to get it back the next day. This is an overnight transaction that happens every night between banks, right? Okay, so this is Fed funds purchase, this is Fed funds sold over here, and so these are essentially short-term loans to other banks, and these are short-term loans from other banks. With me so far? Okay. And then, of course, you have the standard business of banks, which is loans and lease receivables, and you see a whole bunch of different types of loans over here. Okay. I'm going to skip over this. This is just a distribution of what banks look like. As you can see over here, we are talking about totally, there are 1,335 banks with less than $100 million in assets. There are 3,369 banks with $100 to $1 billion in assets. 635 of them with more between $1 billion and $10 billion, and 138 with between over $10 billion. So this includes the Silicon Valley banks, the M&T Bank, JP Morgan, Bank of America, Citigroup. All of them are in this 138 group. And these small ones, you can see there are a bunch. This is a tiny, tiny bank. Think about assets of $100 million. That's a really small bank. That's a one branch bank, right? Maybe two. If you drive from here to Rochester, along the way you see these little towns with little bank names on them. And you always wonder, what are they doing? Turns out they just have 2 branches and they run a bank. It's very unique to the US. I haven't seen that elsewhere. It's very unique, the number of tiny banks here that float around. Okay. Now, let's talk about Silicon Valley. What happened? Let's stare at the balance sheet. Everything that happened is right there, and there's no surprises. If anybody had looked at this balance sheet, they could have seen it coming in one way or the other. Let's try and see how. Can you see it? Kinda? No? Yeah.
Health insurance security.
Who said no? Stavros, you're welcome. Right here. You'll be able to see it. Go ahead.
Their health insurance security from fair value, 76,000.
Let me see if I can zoom this in. No, I cannot. Can you zoom in PowerPoint? Not in present mode? Hold on. Let's just see a picture. Better? Better? Okay. Absolutely. Okay, so let's start with the liability side of the balance sheet, which is the more interesting part, right? Which is right here. Okay, let's stare at this. This is 2021. This is 2022. What's the first thing that you see? What's going on? Did they? Remember, this is 2021, this is 2022. The total balance sheet has remained roughly the same size. So far, so good?
Yep.
Right? Okay, now let's take a look and see what's going on. What happened with deposits?
It's increased from 71 to 13,565.
The deposits have gone from 189 billion to 173 billion. With me? Good? Okay, so it's gone down by $16 billion, which means people have withdrawn cash. $16 billion is left the bank. So far, so good? But that's not all. What is happening? Essentially, look at the composition of this. The composition of these deposits have significantly changed. They've gone from being non-interest bearing demand deposits to interest bearing deposits. With me? Okay, so $125 billion of checking accounts. These are the checking accounts. This is the cheap money that they have, right? The cheap money used to be $125 billion. Within 1 year, 45 billion of that has gone. Why? Because interest rates are rising. So nobody wants to keep their money sitting in demand deposits in your checking account. So they're pulling it out and putting it in CD. They're putting it somewhere else. With me? Okay. So the 125 has gone to 80 billion, and the 63 billion has gone to 92 billion. With me? Okay. So that is one problem. One issue that immediately pops up is they're making less money on this now. What used to be relatively free, cheap deposits has now become more expensive deposits, which essentially means automatically the net interest margin, which is the amount difference between what they make on the loans minus what they pay on the deposits, is shrinking. Good? Okay. Now it gets more interesting. So let's take a look at the total equity. What is the total equity? It's about $16 billion. That has not changed. Right? Okay. Let me come back to this in a minute. This is M&T Bank. Okay. So so let me show you M&T Bank's number. Liabilities. What do you see with their numbers? This is the reason I'm bringing M&T is M&T is a boring state bank out of Buffalo, New York, right? It's the bank that does just regular banking, no fancy banking like Silicon Valley, the banker to the VCs, which is the glamour stuff, right? Which is the glamour banking. M&T is the boring bank. It does banking to me, so no growth value there. Okay, so look at this. Look at the interest-bearing deposits. First of all, total deposits, which way has it gone? It's gone up by $30 billion. With me? Not only that, their demand deposits, their non-interest bearing deposits have actually gone up during this period from 60 to 65 billion. And why does this matter? Why do we care about this non-interest bearing deposit? One is the cost, but what is the other reason?
Bank can earn income by giving the money to the Fed. Interest out of the Fed.
There's a more fundamental reason why we care about that number.
Money is coming into the bank.
It's not withdrawable.
It is withdrawable, right? It's a checking account.
No, I talked about the second one.
No, so that's interest checking. So the non-interest bearing deposits are the ones that are the regular checking accounts, right? Those tend to be like the interest checking deposits are the high, yeah.
What is the Fed funds rate in terms of balance?
But why?
Yes, it's free money, it's able to be withdrawn, so it's used well.
This one about reserve levels against the overall treatment.
It helps, but why? It does count, but why? That's my question.
So they then sell that to banks that
You can't sell your deposits. Your deposits are
not
going
only
to
like the extra that goes above and beyond the
minimum reserve requirements. No, that's different. That the reserve requirements are different from the deposits themselves. Yeah.
Because it probably helps them maintain like profitability due to the spread, since they have like lower higher non-interest bearing.
True. I said spread is one reason, right? It's cheap deposit, but there is a more significant reason for that. Yeah.
Is it securities during the pandemic and people want to run it? How does the bank run?
How?
Because we have more reserves than we're going to grow.
No, this is not reserves. This is deposit. Right? So I'm telling my statement. The question I have is why is non-interest bearing deposits a good thing relative to a time deposit or an interest checking deposit? In what sense? That's right. Yeah, go ahead.
Yes, I think if you have a higher portion of low interest bearing deposits, you're less likely to see higher interest generating assets.
And so what does that mean?
So it means you're less likely to invest in like fixed income.
And so
that's the risk.
in what way?
Term.
When interest is low,
No, nothing to do with interest rate. What way? What other way?
You have more people, a broader pool of individuals, so they're less likely to pull the money out because it's so leverage.
So let's think this through. If you have non-interest bearing deposits, it suggests that
Duration? Management?
it suggests that first of all the amounts are smaller, right? If the amount is big, you're more likely to seek interest on that amount, right? If you have $400,000, you're not going to leave it and say, I don't want any interest. You're going to look for a CD, you're going to look for some place where you can make some money on it. You with me? So when you have non-interest bearing deposits, it suggests that the amount is a smaller amount under the 250 level, which then means that people are not going to withdraw that money, even in the event of a panic, because it's protected, it's FDIC protected, right? So what does that mean? It means that if there's a bank run, that money is unlikely to leave. What's the first money that goes when there's a bank run? It's the big ones. It's the big numbers that go, right? And it also means that there are lots of people who are putting that money in small amounts, which suggests they're not going to leave. So if you have $2,000 sitting in your bank account, it's not going to cause a panic. If you have $500,000 sitting there, that's going to cause a panic. You see the difference? Big deal. And that's why they're called core deposits. Anything less than 250,000 from a banker's perspective is called a core deposit. The higher the core deposit, the safer the bank. It is one of the key measures for bank liquidity safety. And that's core deposits. Yeah.
So I don't follow how the percentage of non-interest bearing how many people are at retail bank and retail, how much retail bank are you?
So think about it. You can get more direct measures. I'm saying just looking at this, the bank actually will have it in the 10K. I'll show you. They will actually have what is the core deposits written out. Tompkins has it, right? I'm sorry, M&T Bank tells you what is the core deposit. But the core deposit is defined as anything less than $250,000. The thought process is you don't need to look at all that. By looking at the non-interest bearing, I get a good idea, because non-interest, if it's a big amount, it's very likely that the depositor is going to look for interest, either through a CD. When interest rates are rising, why do you think money is moving? You can still see money is moving. When interest rates rise, time deposits will go up. Why? Because you can get more money. Why would I leave it with the bank? The only reason you leave that money with the bank for no interest is either it's something for your working capital.
Also, we're looking at the change in, so I think it's the change from year to year that matters.
It's not, no, it's also level. Ultimately, what percentage of your balance sheet is supported by this kind of core deposits matters. And that's where we're going to go next. So usually for a bank, about 90%, 80 to 90% of your funding comes from deposits. And then core deposits should be at least half of that or more. So, I'll show you. And so the level of your core deposits matters, because that tells you something about how safe it is. So that, if you go back and look at the previous slide I just showed you, right here, look at what happened to the core non-interest bearing deposits here. It's disappearing from this bank. That's a cause for concern. No, even the level will matter. The change makes it worse, is all I'm saying. If you can start at a healthy level and go to a bad level, you can start at a bad level and go to a worse level. Both matter. The direction matters, the level matters, right? The level matters because it tells you what will happen in the event of a bank run. How sensitive are you to this, right? Okay, I'm just looking at the liability side of the balance sheet. So I'm going to skip. This is JP Morgan. I'm going to skip it. There's no point. I'll come back to it if I need to. But this is one of the key measures for liquidity analysis for a bank. It's net non-core funding dependence. How much of your assets are funded by non-core liabilities? Where non-core is defined by the FDIC as short-term, as deposit from March, right here, 250,000 or more. So anything over 250,000 deposit is treated as non-core. In the case of Silicon Valley Bank, 90% of the deposit base was non-core, which is unheard of. Which is, the moment you see that, you know they're in trouble. And I'll show you why in a moment. Okay, so in the case of M&T, you'll see that most of it is core. Very little of it is non-core. And so fundamentally, they're different banks in the level of the risk they carry. Right? Okay, coming back to now let's look at the asset side a little bit. Now, the problem usually is that banks have an asset liability mismatch. What does that mean? What is the business banks are? What's the business they generally are in? Why do banks exist? They're taking money from people who have excess capital and giving it to people who need the capital. Period. They are intermediaries. But what is the mismatch that they are always dealing with, that they have to worry about? Which is? Demand. So that's the fundamental mismatch, which is the liability side is demand deposits, which is very short duration, very short horizon. On the other hand, they're lending on long duration. So if you're giving a mortgage is a 30-year mortgage has a duration of 10 years on average. That's how it works. So you're giving a loan that's a 10-year loan, but you're borrowing using a short-term horizon. And that causes risk. That causes what kind of risk? It causes a solvency risk too, right? Because if you run out of the right-hand side, you're stuck with the left-hand side. What does it? If you run out of deposits, you're stuck with loans that are long-term. You can't get those loans back quickly. to pay those deposits. Do you see what I'm saying? So there's that risk. There's also a risk to the income statement, because if rates rise on your deposits, your income is fixed because you're stuck with giving long-term loans. So you're fixed. Look at what's happening right now. Not a good scenario for banks. Why? Short-term rates have moved higher. A lot of them have locked in their loans at 2%, 3%, 4% over the last 3 years, right? They've given 30-year mortgages that are at 3%. They're paying 3% now on a lot of, or more, on the short-term deposits. That's not a good situation. Now, a lot of them they've been sold to Fannie and Freddie and other places. So the good banks, that's what treasury in a bank does. It manages this risk. So a good bank will manage it. What we'll see is that Silicon Valley Bank did none of this. They had no treasury management, or very, very poor treasury management. What is worse is it's the depositors in Silicon Valley Bank. Fundamentally a different group, and I'll show you how. Just okay. Okay, so it's for such smart people, they do such stupid things. It's crazy. It's scary. That's because it comes from a place of arrogance. You know, it's like, I know it all. I'm not going to, doesn't matter here. Because they're successful in one thing, doesn't mean they don't think it's worth spending money or time on something else. Anyway, okay. Let's look at the asset side for a moment for Silicon Valley Bank. What strikes you? This is an interesting bank. This problem that this bank has faced is a very unusual problem. It is so different from any other bank run that I've seen before, because the source of this bank run is totally unique. Yeah.
I think I'm worried about the cash management.
Okay. What are you worried about?
Just comparing to the deposits, I mean, it looks like they don't have enough cash.
No bank will have it, right? No bank will carry enough cash to meet its deposits. Okay, so the question is, how much cash are they carrying? But let me walk you through what's happening with cash. Roughly the same. With me? Hasn't changed year to year. Roughly 14 billion. You can see it, 14 billion. Do I need to make it bigger? Can you see this? Yeah? 14 billion. Okay. This is the interesting. So what is AFS? Available for sale securities is what? They can sell them, but what are they doing? They're using the cash and they bought securities, right? In this case, they bought treasuries. With me? And what happens with that number, which is available for sale? It gets marked to market. So that number that you're seeing, $26 billion, $27 billion, is the market value. The cost is shown at $28.6 billion and $27.3 billion, right up there. Do you see that? This is what they bought it for. This is what it's worth right now. They've lost $2 billion on it. With me? Okay. What about held to maturity securities?
Book value.
What are those? After 2008, so 2008, everything used to get marked to market. After 2008, so the thought process in 2008 was a lot of volatility that happened. A lot of the banks that got into trouble was because they were marking their investments, their securities to market. So after 2008, the accounting regulators came around and said, you know what? If you decide, if you make it clear that you're going to hold these securities to maturity, you do not need to mark them to market. Because after 2008, what was happening? Things were getting marked to market, huge losses were showing up on the income statement, people were panicking. So the regulators came back and said, okay, you don't need to do it if you decide that you're going to hold this to maturity. No mark to market needs to be done. Why? What's the thought process?
Reduce money.
No, what's the, yeah. Exactly. on maturity, you hit par value. So it doesn't matter whether you have losses and gains in the middle. If you hold it to maturity, you're going to make exactly what you expected at the start. You're going to recover your $100. These are treasury. There's no credit risk. You're with me? the only risk is interest rate risk. You get the idea? Okay. What Silicon Valley Bank has shown us is that's a flawed argument. How is that flawed? Go ahead.
You need to sell and generate liquidity.
It's flawed if you need to sell them, right? That's the problem. The problem is, can you actually hold it to maturity? The assumption, the bank might make the assumption that I'm going to hold it to maturity, but can they actually? Silicon Valley's case, they could not. That's what caused all of this to fall apart, right? Now, because if you really think about it, that same problem could exist for loans and leases as well. If I've given a 2% or 3% mortgage and it's sitting on my balance sheet, right? And interest rates go up, what happens to the value of that mortgage? It goes down, right? But you don't see banks marking that to market. Why? Because the idea is that you're going to hold it to maturity. So it's the same thought process. So it can occur even at the loans level, but in the case of investments, it's starker because that's the first thing you try to sell when you're in trouble. You're with me? So essentially, look at Silicon Valley. What was their loss? What are the losses that have not been recognized? 15 billion. How do I know that? How do you know that? So the fair value is given as what? $76 billion. If you look, do you see it? Right here. Fair value is 76 billion. It is being carried at $91 billion on the balance sheet. That means there's $15 billion of losses that have not shown up in the income statement. You with me? If they were to sell their entire portfolio today, they would lose $15 billion on it. Go back and look at their equity. This company is insolvent. It's close to insolvency. You see that? If they were to mark their investments, their long-term investments to market, their equity would go to zero. That's the scary part. It's staring right at you. This is an insolvent company. It's the accounting rules that are making it look like it's solvent. And the tier 1, tier 2 capital ratios that the regulators look at are based on that par value, not the fair value. So even those will look good. And so everybody's staring at those numbers and saying, oh, healthy, healthy, healthy. It's not healthy. It's healthy so long as they can hold it to maturity. But if something happens that doesn't allow them to do it, they're screwed. Any questions? Yeah.
You mentioned that the core deposit should be typically 50% of total deposits. In case of SVB, it's about 46%. In case of MNP, it's about 39%. So isn't SVB in relation to MNP?
It's actually not a problem if you look at just the core deposits.
Okay, so
This is a different story. This is a trickier story than it seems. And we'll come to that in a minute, right? It's a fascinating bank in terms of pulling out what can make banks fail and what are the problems that you look at. Use this one for the rest of your lives and you will do good banking, right? If you ever run a bank or think about this case, it's fascinating in many dimensions. On the asset side, on the liability side, on the income statement. I won't go through the income statement, but all three dimensions. It's a bank that really screwed up on all three ways. Without it seem obvious that they're screwing up, now it's obvious when you go back and look at it, right? And I'll come to that in a minute. Yeah.
Did anybody notice this?
So turns out regulators actually did not. Yes, people noticed it, and there were people actually who wrote about it, but the focus was on the big banks. Nobody thought a small bank of this or a smaller big bank can cause this much of a problem. So when this whole, in fact, the CEO of Silicon Valley, SIVB, was one of the biggest proponents of why they should not focus on us as systemically important banks. All the focus of the regulators have been on the systemically important banks, the GSIS or GSIB, right? These guys made a huge pitch not to be part of that, and that's how they're. Now it's all different. It's a whole new environment. Everything is. But we'll talk about. Okay, hold on. What else? Any questions? Okay. So this is a great piece that was written by JP Morgan on this. Came out a couple of days ago. So this is the growth in the balance sheet. This was the star bank, right? Everybody is talking about the bank because Silicon Valley Bank was growing. The asset growth was enormous, 250% growth in 3 years in their asset base. Where was this coming from? Tons of money, right? They have to put it somewhere. Where do they put it? Silicon Valley Bank. It's the go-to bank. So all the VCs, all their companies were taking the money and dumping it in here. And these guys were what they peaked at. When they closed, it was $100. It peaked at $750. The share price, and now it's zero, as we know. But look at it. Here's one. Here's Signature Bank, which was the other bank that went under. Right? They're all up there in terms of growth. Uninsured share of customers' deposits. This is your non-core deposits that I was talking about. Remember, about 250,000. Look at Signature and SIVB, the two banks that went under. 90%. Do you see that? And why does this matter again? So this goes back to your question. You asked me, you said the deposit base looks pretty good, right? But this is the core. By looking at that, your line, you actually didn't know. So let me clarify. It was non-interest bearing potentially when you see that and you think it's core, but it could be a 500,000 non-interest bearing account. And that's essentially what was happening. And this is why people are puzzled. Remember, Circle, the crypto firm, had $3 billion sitting there. $3 billion, right? Roku had $500 million. The first thing people are asking is, what the hell was Roku's treasury department doing? What was Circle? How do you keep amounts like this in one bank? It's unheard of. It's absolutely ridiculous. There were so many of them, so they are not core deposits. They're actually about 250,000, which makes them non-core, even though they're not interest-bearing. You and I would not do that. If it's more than a certain amount, I hope you would go and seek some kind of interest from it. Those guys were so flush with money that they were putting these huge amounts. Whether it's interest bearing or not doesn't matter. When it goes about 250, it becomes non-core. Why? Because people will pull it and you don't have FDIC insurance. That's 90% over there. Really bad. And so the problem these guys ran into is that you had a bunch of big two things. One is concentration of their depositor base. It so happens that that the bank was exposed to the same kind of risk, which is venture capital risk. Venture capital over the last year has seen withdrawals. Why? Because suddenly money is not available anymore. So they've been seeing withdrawals. Why did they start selling their long-term treasuries? Remember, they were hold to market or hold to maturity. Why were they selling it? It was because money was getting withdrawn. Why? Because these firms that were being run by venture capitalists needed the cash, right? And they were pulling that cash out to spend it. These guys didn't have the money, didn't have enough cash, so they ended up selling their treasuries. That caused a $1.9 billion loss, which then triggered the need to go out and raise capital, which triggered a fear. That's when it all began. That's what happened in that one day on Friday or Tuesday or Thursday, whichever day it was. To give you the story. So this is the heart of the problem here. This, along with the fact that they had $16 billion sitting in losses that were not recognized, right? In mark-to-market losses that were not recognized. So now the fear is how many more banks exist like this, which is why there's been all this running around trying to find out, which is why banks are tanking. They're wondering how much more losses. So to give you some idea, this is the US bank loan to deposit ratios. So let's take a look here. So on the y-axis here is the retail deposit as a percentage of total deposits. So how much retail deposit is sticky deposit? That's good deposits. It's the mom and pop deposits, $5,000, $10,000, unlikely to come and go. You put your salary in there, you spend it, your new salary comes in, you spend it, that kind of stuff. That's the kind of deposits you actually want because it stays. You don't go to a different place. So if you look at SIVB, it's horrible on all both dimensions. It's retail deposit to total deposits is almost zero. Why? Because all of its customers are people who want to get these fancy stuff in their offices and sofas to sit and think about deep things and stuff like that. The new way of working, which is you want these open floor plans where you can whatever. I like my office. So anyway, so as you can see, I have a bit of a chip on my shoulder when it comes to that stuff. Just because you sit back and you have this, what is that thing, the bubble couch or whatever, it doesn't mean you take special ideas in your head. Anyway, so this is the risk deposit base. So this here is retail deposit to total deposits, and this is loans as a percentage of deposits. And they've given 110% as loans and securities as a percentage of deposits. Very risky company, clearly. This is the other company that went under, same risk. Citi is an interesting one. Citi shows up in all of this, right next to these firms. Anyway, okay, so here is the funding. This is the problem they ran into. So they had early stage technology firms as their funders, it's even worse because remember I told you their off-balance sheet is as big as their deposits. They have $177 billion in deposits. They have $177 billion in off-balance sheet financing. This is why venture capital was screaming. They're so scared. If this company disappears, if this bank goes out of business, they're in deep trouble because a lot of their lines of credits will disappear. Their their ability to spend day-to-day disappears. So the loss of SBNY, Silicon Valley, SVIB would basically change the landscape for venture capitalists because of both this and that, both pieces. This is a piece that you won't recognize normally, but it's huge for a lot of these firms. Okay. Any questions? Yeah.
Can you elaborate on off-balance sheet?
Lines of credit is an example. So if you need, so that's your way to manage your daily liquidity for a firm. You have a line of credit that shows up here. When the credit gets drawn on, it shows up here. Not in deposits, but it shows up as liability.
Like,
Yeah, it can be any kind, right? So, but the problem is for a firm, if this disappears, it's a big problem. That means they have to find cash somewhere else, short-term cash somewhere else. So, a lot of it, as you can see, is basically young startups who sold business. And when startups are in trouble, a bank got into trouble. Unusual exposure to one line of business. Very, very unusual. In fact, most banking reports, if you read M&T's bank, their MD&A, the management discussion and analysis, the first thing they start with is say, we have a well-diversified depositor base. That's how it starts. I looked at Silicon Valley Bank's discussion, nothing about deposits. Nothing. Zero. It's all about how we're growing and how we are helping venture capitalists and how we're doing this, how we're doing. Nothing about the bank itself. Nothing about banking. It's crazy. I was reading it and going, oh my God. Nothing that makes it look like a bank. Anyway. Okay. So this is essentially the same idea. This is showing that, look at Silicon Valley. Talk about an outlier. That is their adjusted. So if you adjust for an unrealized, remember I showed that equity goes to zero? That's essentially what these guys are showing here. If you adjust for the losses, they have no capital left. It goes to zero. But this problem exists for a lot of banks. There is $750 billion of unrecognized losses sitting on banks' balance sheets. That's a lot of money sitting there, right? So the question is, what's the next shoe? Will a shoe drop, or has the government saved the day? Has the Fed come in and saved the day and made everything okay? Or is something else going to go under? Yeah.
How much of that do you analysts look at and see if they swapped any of that debt to those assets and weren't burned as much on the way up with rates?
So most banks don't do what these, if you look at most banks, they will not do what these guys did. These guys ended up buying long term. They wanted that extra yield. Most banks would buy notes. And so if you look at the percentage of these long-term held-to-maturity instruments, if you take M&T, for example, you can see it, it's barely there. It's a small number. They have $26 billion of equity. The total losses are less than $1 billion on that. Because banks don't want to take that risk. That's not, these guys did not do any of this. And for all this risk these firms are carrying, they were getting 60 basis points more in interest. Silicon Valley was paying its depositors 60 basis points more than other banks were paying. So these guys decided, forget it, underwriting risk, be damned, I'll collect that 50 basis points. And now they're being made whole. That pisses me off. This is a world where you misbehave and it's okay. Why? Because we have to save the world. Happens again and again and again. There is no penalty to be paid. Yeah.
I'm curious on the timing. This bank is started, seems like it is doing that. Is there a change kind of a consensus of this? Maybe it's doing that.
Yeah, I think it's just gotten the money became so cheap in the last several years that it just what do you call it? What's the term for it? It speeded up everything, right? There's so much cheap money. Money has never been as cheap as it was in the last 4 years. And that's what made all the difference. So this is the problem, right? This is what we are facing right now. And I said this a year ago. What we are facing right now is the unintended but foreseen consequences. And people who are thinking about it were thinking, when this happens, it's going to cause a lot of disruption, a lot of problems. But it was all about kicking the ball down the road. Well, we've arrived there, right? And so now the interesting question is going to be, what's the Fed going to do? And we're going to see that soon. When is the next meeting? Tomorrow, day after, whenever, next week? Are they going to raise interest rates? Are they going to keep it flat? Are they going to start cutting? How far can they cut? Will they go back to the same regime of zero just to get things going? But if they do, they're raising all the same problems that we saw over the last 7 years. Have they learned from it? What is the middle ground? I don't know the answers, but these are all things that matter to every one of you. The next 5-7 years are going to be driven by answers to these questions. Yeah.
So how can maturity going to be an issue for all the banks here? So how do you kind of,
Absolutely.
they're all going to show massive losses.
That's the 750 billion sitting there on balance sheets. That's exactly what the chart is showing.
Prevent that? I mean,
There's nothing to prevent. They have to
there's
eat
going
it.
to be an issue across every bank. So.
No, so the difference is $750 billion sitting there. It's a lot of banks, by the way, right? So it's distributed over lots of banks, and different banks will have different exposures to it. I told you M&T, for example, could take the loss and it would hit it by $1 billion on $20 billion of equity. This is going to be a one-on-one. Now, the only other hope is that if interest rates start to drop, these losses, which are unrealized, will go away. The fear is, as long as the losses remain unrealized and you can hold it to maturity, you're okay. It's only if the losses become realized that the problem happens. So this entire 750 billion can be okay if nothing happens to the banking sector and things work out to maturity. You see that? And that's why the Fed is really scared. We cannot afford to have those become realized. That's a lot. Yeah.
Just to go into
program where they allow banks to take loans out
Correct.
on their bond.
That's right.
That fixes this.
At
problem.
par value, that's the important feature, yeah.
Right, so that fixes the problem you brought up, but doesn't that over leverage the financial system overall?
Oh, yeah, so right now, all they want to do is they're taking the money, so that's a way of them saying, listen, we'll buy it at par, we will hold it at par to maturity. The Fed can hold anything to par, at par to maturity, right?
They traded hands close to that.
Yeah, yeah, it's a problem. I actually think these are all band-aids. And they have, the reality is, if you ask me, did they do the right thing? I will be forced to say yes, they did the right thing. Why? Because the consequences are unknown and can be enormous. It can be a great depression kind of, it is possible, right? Because if people lose faith in the banking sector, all hell breaks loose. There's no end to it, because I will start pulling my money out. Where do you keep the money? What do you do with it? You don't invest anymore. Everything comes to a standstill. Which is why Bitcoin is up to 24,000, right? Was up 19% on one day. You're going, wow, that's a, yeah.
I know Credit Suisse has been in the headlines, is this just a coincidence or is this?
So Credit Suisse is it's a little bit of a coincidence. It's a different problem, and we'll come to that in a minute, right? So, yeah.
Maybe more in talking about just like a week ago before this happened, they had outperforming stuff. We had so what's your thoughts on like the equity analysts never touched
Let's not go there. People who are going to be equity analysts, I wish them the very best. I want them to do well. Come back and give lots of money to the school. So I will go there. That said, right? I will say what I have to say, but equity analysts are constrained by their incentive structure, right? You might believe something. Now we knew many years ago how bad this was. Any of you know what the global settlement is? It's a whole new generation. It was the talk of the town, the global settlement. Clearly, none of you have heard of it. It was a settlement made between the government and the 8 biggest banks in 2001 or 2002, after the tech bubble crash, where they created the Chinese wall between equity research and investment banking. There was no Chinese wall. So it was very openly discussed, where the investment banker would go to the equity analyst and say, listen, we have a great deal coming along here, give a buy rating. Done, right? That's how it worked. Equity analysts used to be paid out of investment banking revenues, right? In some form or the other. Trading revenues was a big one too, right? So then global settlement essentially was an agreement. They paid a lot of money, $1 billion, $2 billion, something, to as a sorry, the top 8 banks. And then they're supposed to have created this Chinese wall. I think the Chinese wall lasted for 2-3 years, and then after that, everybody's climbing all over the wall. So I don't think anything has changed effectively. Maybe it has changed to some extent, but you can ask Drew Pascarella whether it has changed or not. But the so to your question, in all fairness, though there were people who had pointed this problem out, it's hard to know when and if it would have gotten triggered. That's the problem, right? It got triggered by this unusual situation of so much money being withdrawn from these banks, from this bank, and them having to sell their instruments and realizing those losses, and then people panicking about it. So then they had to go and try and raise capital, and that's when the panic set in. So if the withdrawals had not happened, then that wouldn't have triggered the sale, that wouldn't have triggered the capital raise, things could have gone up. And maybe they could have seen it through to maturity, maybe not. So it's also a problem of the music is playing, let it keep playing. But when it stops, everybody panics. So let me give you a Caruana. I've been screaming, for me it was my favorite story. Analysts followed it all the way up and followed it all the way down. Followed it is the term, right? Every time it went up in price, they raised their they were well behind, they would raise it, and then it would go way beyond that, they would raise it, go way beyond, and then they followed it down all the way. As it kept going down, they kept revising downwards. until they finally overtook it when they said it's worth $1. And now it's not worth $1, it's gone up, it's gone the other way. They'll chase it up to it, it goes up and down. So it is, do they have valuable information? Yes. That number is not necessarily that information. Whether it's a buy or sell, I don't think people should necessarily pay attention to that. My sense is most of the buy side talks to them for more qualitative information, not for whether they think it's a buy or sell. It's only retail that stares at it. Right? Does that kind of make sense? Yeah.
So what exactly triggered the big amount of withdrawal from the American?
What triggered? Oh, because a lot of these, so two things happened, right? First, withdrawals have been happening because the firms are starved for cash now. They didn't have as much cash and so they needed to start burning through their cash. Earlier, it was easy to get more and more cash. It was easy to raise capital, raise debt. That stopped in the last year and a half. So they have been burning through their existing cash. And all of their cash is sitting with one bank. So they've been burning through that. That's the big reason it happened. Then, of course, it got worse when once it started, all the VCs, what's the name of the guy who said, pull out all your money, told all this? Here. He basically said, pull out all your money. And once that happens, you're done. The moment I saw that, I was like, this bank is toast, it's over. Because he announces it to one person, his set of firms, everybody has to leave. They cannot not leave because sheer fiduciary duty forces you to leave. I'll give you an example. 2008, I was running the Cayuga Fund, right? We had $16 million in the fund here. I had $9 million long. I had about $4.5 million short. Our prime broker was Citigroup. Smith Barney was a prime broker, right? I don't know if you remember, but there was a time people thought Citigroup will go out of business. This was after Lehman. The week that weekend Lehman went under, right? The next week, the thought was on that Thursday, people were talking about that weekend Citigroup going under. We had all of our business, all of the Cayuga Fund's business, they were a prime broker, right? So we had all of the money with them. So my problem as the fiduciary, I was the manager of the fund. My problem as a fiduciary is what do I do? Do I sit there and wait and see what happens, or do I do something preemptively, right? That was the question I had to deal with. So what I decided to do, if I don't do anything and Citi goes out of business, I'm stuck, I'm toast. People will, even though I'm a professor, the reality is I'm running this, and it's an educational mandate, but it's somebody else's money. Right? I still am responsible for that money. So what I did was I took all the cash that I could move from Citi and moved it to Tompkins Trust Company on Friday morning. Because I did not want to go through, I couldn't sell all the stocks and get all the money. Not enough time to make that happen. So I took all the free cash that I had, which was $5.5 million or something, all the free cash that I had, I transferred it, you know why I transferred to Tompkins Trust? Tompkins Trust called me, the vice president, and said, we are seeing an enormous amount of money coming in. What the hell is going on? So I said, it's all good, don't worry, it's coming. Not a problem. So I transferred $5.5 million. If everybody was doing this, that's a run on Citi. It would have made an existing problem much worse because they have to come up with the cash to generate that, right? That's what a bank run is. And so a bunch of hedge funds were doing exactly what I was doing. Citi survived, it managed it, right? And then 2 weeks later, I moved it back. I moved the $5.5 million back. A couple of weeks later, once I knew everything was stable. That's how it works. It's a confidence business, banking. Yeah.
Do you think you made the decision out of like investor pressure, or did you really feel it was the right thing to do, like
moving Citi? There was no investor pressure, zero. No, nobody called me. They didn't even know what was going on. I had to do it from a fiduciary duty. I had to do what was best for my investors, which is protect our cash, which is what Peter Thiel did. You can't blame Peter Thiel. I completely would have told the same thing. If I was in his shoes, I would have said the same thing. I would have said, move your money out. People are faulting him. Other VCs are saying, what the hell is that? No, my job is to protect my investors. And that's all I care about. I'm not beholden to the bank. I don't care about the bank. I have no reason to care. It's only the investors that matter. So no pressure. I moved it because I had to protect as much of the assets I could in case Citi goes under. Virginia, from what I understand, Virginia's student fund ran into the problem. They had Lehman as their prime broker. It took them years to pull it out. Huge problem. So, yeah.
So with the Fed stepping in, what seems like, I guess, over the last few days, a lot of regional banks have still taken a greater than a 50 or 60% hit. Do you think investor sentiment is overdone about that, or is this problem SVB specific now that the Fed has come up with a couple programs?
So there are two issues here, right? Is it overdone? Probably. How much is it overdone? I have no idea. Here's the problem, because there is a fundamental aspect to this. Fundamentally, a lot of these banks have changed. In what sense? It has changed, these banks have changed in the amount of regulation they're going to face going forward, in the kind of loans they're going to be able to give, in the kind of ways they're going to be able to raise deposits. What was loose regulation all this time? They called it light touch. Beyond the GSIBs, which is the globally systemically important banks. Beyond that, it was all considered what's called light touch, these banks. That's what SVB's CEO was demanding, right? And so that model is gone. They are going to be all over these banks. And so, first of all, their business model has changed, one. Two, I think they're not going to have the same depositor base as they had. They're actually going to be weaker fundamentally. Because even though the Fed says all this, people will say, you know what, why do I risk it? Let me just go to a JPM or a Citi or a Bank of America, or something like that. Why should I even risk being at Timbuktu State Bank or whatever it is, right? It doesn't matter. So there's a fundamental change in the business model. I can't separate between the two. It's too quick to know what's going to happen. So in my sense, I don't know whether it's cheap or expensive. I just have stepped away and I'm going to watch the show. Right? Because I can't separate between investor sentiment here and what is fundamentally changing with these banks until I see how it goes. Right? Okay. So what else? There was one other thing. So then that raises the question. So let me ask you a question. So it comes back to my question. Oh, so just to let you know, did you see what was just announced? What? Oh, Credit Suisse, I'll come to. What got announced?
Yeah, the regulators are providing liquidity.
Wow, it's just out of control. This is talk about moral hazard.
Swiss regulator.
Yeah.
So here. Oh, everybody. It's some regulator or the other, right? Has to show up. So here. So this is from FDIC. So FDIC has said that today transferred all deposits, both insured and uninsured, and substantially all assets of the former Silicon Valley Bank of Santa Clara, California, to the newly created full-service FDIC-operated Bridge Bank. Depositors will have full access to their money beginning this morning when Silicon Valley Bridge Bank, the Bridge Bank opens and resumes normal banking hours and activities, including online banking. Depositors and borrowers will automatically become customers, blah, blah, blah. Loan customers should continue making same loan payments as usual. And so transfer of all deposits was completed under the systemic risk exception approved yesterday. All depositors will be made whole. No losses associated with the resolution will be borne by taxpayers. Unsecured will not be protected. Senior management has been removed. Any losses to the deposit insurance fund will be charged as special assessment to the bank as required by law. So essentially, anything that they have to pay in excess will all be borne by other banks, is what they're saying. The receiver also transferred blah, blah, blah. Bridge Bank is so on and so forth. And Silicon Valley Bank just announced today that they sent out a statement to all the customers saying, business as usual, come back to us. I hope you all come back to us. We will be exactly the same, no difference. Everything will operate identically to what it has been in the past. Yeah.
So what's the value of FDIC insurance at this point? And I'm going to do anything.
So
Essentially worthless.
what is very interesting is that document, which Matt sent me, I can't show it to you because it's on my email, I tried to find it, but it came out today from Silicon Valley Bridge Bank. But it basically says, we are safer than every other bank in the US right now. That's what it says. Why? Because we are the only ones where all deposits are protected. Think about that. That's the marketing pitch. Crazy, right? You go from a crap system and you suddenly are the best bank in the country now. Because the government decides that that's what they're going to do.
You think the FDIC would have had to figure a bailout for the bank that didn't have 90% of its deposits uninsured? Maybe there was like a bank loan 50% of the deposits uninsured?
Yeah, I don't know the answer to that. I think it's a very noisy group of people that are involved, very powerful, I'm sure. That's a lot of money that was at stake there. And
Did that push it into the systemic category? Or did it not consider systemic risk?
I think given the scale of the bank, $200 billion is a big bank to fail. It's the second biggest failure after Walmart. And so I think they're in a center. The extent to which they're gone is stunning, and that's actually what the next slide says. This is the history of bank failures. And every one of them, there has been a loss imposed on uninsured insurance. Never has it gone 100%. And I don't know if they will change their mind about this, but right now, it's so unique. Look at it, 87 losses were 24% of resolution, bank failures, 14%, 65% between 92 and 2007. And then in 2008, there was a temporary guarantee, but then they finally levied a 28% loss, which means you take a haircut, you don't get all your money back. When you put money in, as uninsured money, you get more interest rate. And so you have to pay the price for it. You have to do that, make that decision. Like every other, we all make those decisions. You carry the risk, you pay the price if it doesn't work. And not in this case, seemingly. Yeah.
You foresee the lawsuit that is going with civil reason beyond that could be
I would be surprised if lawsuits, of course. I would be surprised if there aren't one. The whole industry for that too, right? But who's going to get sued? I guess maybe the management. The management is out right now. So, yeah.
Do you think the bank as a whole should like continue to operate, survive, or like do you think the creditors should force them to like dismantle the bank and like out?
Well,
It
so
seems weird to think that like they should bail out
and that's what the announcement is. And I'm going, so you're going to have the same kind of risk of concentration of depositor concentration. I don't understand this. At some point, how are you going to diversify out? And now, if the venture capitalists go back and do the same thing with the bank, I don't know what to say. After
the question, the FDIC is actually trying to get someone to buy the bank. So assuming the bigger bank buys Silicon Valley Bank, then things is more diversified.
yeah, but the problem with it's not clear they want to buy it necessarily because they don't know what kind of stuff is in there and I don't know. It may or may not happen, but yeah.
And with the pension office structure in the UK, HSBC, the former as well.
Yeah, but that's small enough. This is a big bank. This is $200 billion. So it really has to be one of the top four. And so JP Morgan is at what, $2.5 trillion? So that can absorb it without much. Bank of America could. But if you go down, there aren't many others who can do it, right? Citi maybe, and Wells, I don't know. Wells has its own problems.
I think when the Fed stepped in, they made an emphasis to say like taxpayer dollars like being used.
Yeah.
How is that logistically possible?
So the way they're doing it is they're saying, and I can see that not happening, right? So at least I think let's think it through. So the way they're thinking about it is first the equity will eat the losses, and they're getting wiped out, right? Equity is zero. I showed you, right? Effectively, equity is zero. So they're getting wiped out, and then debt will eat the rest. And so by the time they come to the government, so they're making the depositors whole. So it'll require. So essentially, what it will require is the $16 billion has wiped out equity. then the question is how much of these loans and that they have on the balance sheet, what are they really worth, right? In this environment, if they mark those loans to market, my sense is there could be a bunch of those that can't pay back because they don't have the cash anymore. A lot of the loans were to the venture capital, were to the firms, the entrepreneurs, and so it's not clear what it's worth. So at that point, they're saying that any losses will be borne by other banks through the FDIC. That's what they're saying. My sense is they will be fine still because those, if they can hold those things to maturity, the longer loans, they'll still be fine. So there is a solvency problem where this bank is worth nothing. That's true. But there's also a liquidity problem, unusual. This bank has all kinds of, so if you summarize, has a solvency problem, equity is zero, has a liquidity problem because they had not enough cash, they had not enough core deposits, and then they had this unusual concentration, and then usually banks go under because of credit risk. This wasn't a credit risk story. This was a story of a bank going under because they bought the least, most creditworthy instruments. Think about it. Usually banks go because their mortgages are useless, or the mortgages, they had a housing crash, stuff like that. This is a case where they were fine on the credit side. It was interest rate risk. They owned treasuries, and that's what caused the downfall. Very odd. But that's also because banks don't buy long-term treasuries with short-term deposits. They should have been buying notes, short-term notes. They got greedy. They wanted that spread. They got greedy.
So the FDIC, the insurance is collected from all these banks, is also from the treasury. So how is that going to play out with that market?
The FDIC doesn't care. They'll just get more from the treasury. Really, really more. No, I see a problem, but you're talking about an unlimited source of printing money on one side.
So you just print more yourself.
It's not. So that's true of almost everybody who owns treasuries. They lost a lot of money, long-term treasuries, long-term bonds, right? The idea is you hold it to maturity and you get your power back. And so that's what they do. Yeah.
Is it bad that FDIC must control of the 100% investment involved?
Is it bad? Yeah, I think it's bad. I think it's bad. I think they ought to take a haircut, like they've always done this in the past. But will they? They're scared. They're panicked, right?
Right, because that can just like create precedent for.
This is another example of how the consequences are always. You never know where they come from. If you ask me a week ago what would cause you don't know. People always ask me when is the next what will trigger the next crash. I don't know, but it happens. It will come from somewhere, and it's usually unforeseen. Out of nowhere it comes, right? And so, I'm sorry, you were asking what was your question?
Right, because they pretty much like created a new precedent, right?
That's right. That's right. So I think what they didn't realize by keeping interest rates low is how much of a structural problem they're creating across the economy, across so many industries, private equity, venture capital. Everybody is basically addicted to cheap money, and when the cheap money goes away, hell breaks loose. Yeah.
So what are your thoughts about shadow banking regarding how much contribute to this problem?
Oh yeah.
And also how much problem they will face in this current environment?
I think it's a huge problem. We are not going to have funding. Where are they going to get their funding from? It's going to be an important problem. I don't know if the Fed is going to do more about it. JP Morgan, so Jamie Dimon's annual report last year was a really good report on comparing JP Morgan to shadow bank to the fintechs and asking the question: is this a level playing field, and how much more onerous it is for the systematically important banks versus these firms, and he was making the case that these firms can cause a lot of problems given how big they're getting and how many are there. It's another place where regional banks, government was like whatever, they're focused on the big guys. This is another place that it can problems can happen. And for them, sources of funds is going to be a big problem. I think there's just going to be a drying up right now. Banks are going to be scared to go out and do stuff. They're not going to have the deposits maybe. I don't know. It's going to be, we're going to see how this pans out. That's why the market, banks go up 30% one day and then 20% next day in the last 2 days, right? Because nobody really, everybody's trying to figure out which way it's going to go.
But the FDIC did the bridge bank structure for Sovereign Bank, the other one that failed as well. Is that, was Sovereign Bank failure related to a similar structural issue?
So Sovereign Bank, no, there's there's Signature Bank.
Signature.
Oh, Signature.
Sorry.
So Signature Bank and Silver Lake, Silver Lake, they are different in what way? That's it. It's just that the client base is different. The problem is exactly the same. In these guys, it was venture capital firms. In those two banks, it was crypto. So same problem, withdrawals, losses, realized losses, problem, run of the bank, identical. Now, Credit Suisse is slightly different. Credit Suisse has just a bunch of unforeseen. Now, they have a lot of problems themselves, right? They've had a series of problems. They've had huge depositor withdrawals. If you look at Credit Suisse, if you have it, you see that. Can I pull it up? Yeah, can you see this? Yeah? Give me 2 minutes and then we take a break. So Credit Suisse, if you look at it, it has a huge amount of withdrawals. Let me see if I can find it. The wrong way. Basically, or maybe it's worth seeing it. Some of you are going to go work there, or you're going to deal with it. So now to work. That page is complicated. Where did I couldn't find it? I'm not going to search 200 pages for the balance sheet. I can see.
I'm looking at it.
Right here. Yeah. So look at this. This is the problem that they're running into. I'm sorry, you're looking at the 10K?
No, I'm looking at the one that.
The 20X. Oh, you're looking at their annual report. Yeah, I can find their annual report, but you can see this right here, right? So they don't have the deposits here, but you can see it in the total. What's that?
It says customer deposits are from 392 to 233.
Yeah, that's the problem they're running into, right? So they're running into this problem of an asset base that's shrinking. People are withdrawing money like crazy, and what caused a lot of stress is when they came out, their annual report came out yesterday or 2 days ago. The SEC basically, so they came out with a qualified report, and that compounded the problem. In this environment, to come out and say that the internal controls are deficient is a huge headache. The moment they said that, the panic set in again. So they came out with the annual report. They said the SEC questioned them. They didn't allow them to release the annual report, and so they talked to them about their auditors. You can see it, it's somewhere further down. I read it this morning. Basically saying the internal controls are not up to snuff, both on risk management as well as they have internal control problems on something else that was really critical. There were two things that they had problems with, and that's caused an uproar now. In addition to the fact that they announced that they're losing more deposits, they've lost a lot more deposits since the end of last year, and so it's basically shrinking. And so what that means essentially when that happens is they have to sell assets to meet these payments, and that means they're going to have to sell assets and losses. There's going to be fire sales. So how much losses are they going to bear? How much of the equity is going to get wiped out? All questions that are up in the air, which makes credit risk very risky. Yeah.
Going back to the FDIC, on the regulatory side, have they played around with the idea of raising that 250 for business or corporate accounts versus just labeling all accounts at the 250 cap?
The problem with that is so. Just let me give you an extreme example. What if they did this with every bank? What they did with Silicon Valley? They made it unlimited. So all deposits are insured. That's the equivalent of the GDP. That's a scary proposition. Think about how much you have to charge the bank fee. Banks pay fees to get deposit insurance. There's a charge they pay because the government doesn't want to do this, can't carry all this for free. So the banks, it's part of their doing business. So as you increase the threshold, the government will have to charge a bigger and bigger amount from the banks. So at what point does it stop being feasible for banks? Good banks are going to say, no way, I'm not going to pay this. Just because there's going to be an outlier bank, bad actor, like a Silicon Valley, why should the rest of us, who are pretty good with our risk management, carry this fee? That's going to be the trade-off. Easier said than done. Yeah.
An example of that is thought process in my head. If in theory all deposits have to be protected anyway, because the banking system can never fail and the bank can never fail. So then whether they're insured or not, they're actually insured.
Yeah, this is exactly where this argument goes, right? This is the slippery slope problem. Is you claim that you're going to let these things fail, but when the event happens, you always come to the rescue. So is there always going to be a put option? This is the moral hazard problem. Ex ante, you're saying you will behave in a certain way. The government is saying. In reality, they behave differently. So are people going to get used to this idea that I can behave badly, and when the rubber meets the road, they'll come to rescue me, right? That's the problem. That's why this haircut is important. Come to rescue, but let them pay a price that's greater than what they made. So that's the way they learn a lesson. Not give all of it back. That's somewhere something has to give. So we'll see how it pans out. It's already 4. Let's take a break. Maybe 10 minutes. We'll finish early too. So let's take a 10-minute break.